Are you looking to get ready, be prepared, and transform your financial future? Then you've come to the right place. This is the Get Ready Money podcast with Tony Stewart, where Tony has insightful conversations with financial experts who are changing the way we think about money. Catch up on the latest financial trends and hear practical advice from Tony and his expert guests so you can build healthy habits that work. Be empowered with tips for implementing small changes that can have a big impact on your financial future. So sit back and get ready to hear from today's guest.
Welcome to the Get Ready Money podcast, changing the way we think about money. I'm pleased to be joined today by Charlene Cong. Charlene is an investment coach, Chartered Financial Analyst, founder of FinFit, and YouTube creator. In this episode, I'll be turning the show over to Charlene, who will be guest hosting, and we'll be discussing why whole life insurance is not the solution to every financial question. Charlene, turning it over to you.
Hey Tony, how are you? I'm so happy to be here. So
Yeah,
to be
well,
re- yeah, to be very
sorry.
honest, when it comes to the whole life insurance, I believe you're really the expert out there. So actually, when you turned to me a few weeks ago telling me that, you see a trend actually, young people in the US currently are really, like they are purchasing whole life insurance. They want to be their own banker or infinite banking, whatever we call it. And you see a growing concerns over there. So I just wanted, I'm not based in the US, but I'm super, super interested in what is going on there. Can you just briefly tell us like what is going on right now with young people in the United States and about the whole life insurance and why is it becoming a trend right now?
Well, I think it's becoming a trend mostly because of a lack of financial literacy. And
Mm,
that on its surface, it seems very attractive. And I think, because people don't fully understand investment options, liquidity, surrender charges, some of the basic
mm,
financial principles, that they're easily attracted to things that are an all-in-one solution. And the way these are marketed is that they're
mm.
sort of a Swiss Army knife of financial
Yeah, I'm based in
services.
Switzerland, by the way.
Exactly. Well, that's
Yeah.
why. So that's what happens. So the basic assumption is and sometimes people don't even really realize that they're
Mm,
buying a whole life insurance plan. So they're told that they're purchasing a plan where they can save money for retirement, where
mm, mm.
the concept is that they can borrow money from the insurance company, and that just like banks don't charge themselves money for a loan, is that there's no cost to them. So they're
Mm.
operating like a mini bank. And so that's where the theory comes from. So it's like you're going to put all this money into it, and then the idea is that you can recover money tax free. Well, that at its base, that's correct. But when you go a lot deeper, there's a lot of problems to it.
Okay, so basically what we're saying here is that yeah, of course those insurance company will tell you the positive part of an whole life insurance policy. And of course, there are a lot of benefits of a whole life insurance. Let's just say it's not for everyone, but there are a lot of benefits or pros, but there are definitely a lot of cons that I believe a lot of insurance companies or a lot of insurance agents and they just avoid telling you, right? So my next question to you, Tony, is why do you think, or what do you think is driving young people to commit to these long-term, low liquidity policies? So in another way, I wanted to say, when the insurance company try to sell the insurance to you, what are the key selling point they have in order to attract these people, young people?
Well, really, the insurance companies turn it over to insurance agents to market. The insurance companies aren't necessarily marketing it, but what's happening is there's this huge trend of videos on YouTube and TikTok where people are talking about it, and they
Mm-hmm.
focus really on you're like, hey, this is a tax-free investment. So,
Okay,
that
tax free.
resonate exactly.
Okay, tax
And
free, number one.
yeah, and then they go really into like, hey, your own bank is, banks are profitable. You can be your own bank instead of borrowing money from someone else. You're borrowing money from
Okay. Mm.
yourself. And
Yeah,
that's
so
where it,
secondly, it's like a selling point that try to, okay, banks are our enemies. And then people say, oh, yes, those bankers, they earn a lot. Yeah, they're earning a lot of money for us. So they have this kind of, I mean, I don't know how to say it in English, but this kind of common emotions, right? They try to make you feel like, oh, banks are our enemies. So we are friends.
exactly. And they
Okay.
try to, and they help, they lead people to think that, hey, you can operate like a bank. So
Mm, mm,
so banks make money, they loan out money to people, but if you borrow money from a bank, they charge you interest. And that, if you're your own bank, you're not going to charge yourself interest. So they
mm,
do that and they say, oh, and by the way, you're going to get some life insurance thrown in there, and you're going to have these huge cash values when you get to an older age. And you can just keep doing it. So what they do is they get people to what's called overfunding, which is putting in the maximum amount of money, to
mm,
stuff these policies so the cash values look bigger because they're putting in more money, but they don't get into, the internal rates of return, how the
mm,
tax
mm.
efficiency really works, and a lot of the other issues that are involved with it.
Yeah, exactly. So if I could maybe just like quickly summarize it, yes, there are some good things. For example, tax benefits, right? Compared with probably some other investment vehicles. I don't know for sure, but this is tax-free, whole life insurance. And secondly, they do a lot of good marketing, especially on social media. And then young people, millennials, are on social media, right? And thirdly, probably they really play your emotions really well, and then they make banks as your enemies. And these kind of young people or millennials, they feel yes, we trust you because we don't like banks also. So it's quite interesting, and I have to say these kind of insurance companies or agency they are quite smart. They know how to play the marketing game, right? And Tony, I would like to ask you another question. Why do you think whole life insurance is being marketed so aggressively compared with, let's say, some other financial instruments or financial products and investments to these young audiences? Like back in my time, I'm not saying back in my time, it seems like I'm so too old now. I mean, back when I was really young-ish, or I was in my 20s, I mean, insurance, yes, I knew the word back then or after graduation, but I wouldn't say it's like a word or a product for young people. When it comes to insurance, I thought, oh, it's only for those sick guys or some are going to be sick, older. But now it's just like it's new to me that young people you told me in the United States are, proactively buying whole life insurance. So I would like to ask, why do you think it's being so aggressively marketed at this point to young people?
Well, the thing is that, it gets back to financial literacy. Is young
Hmm.
people really, they may not know as much about IRAs and other tax deferred retirement savings accounts. So an IRA, individual retirement account, will offer them the same tax deferral. So you put money into it,
Hmm.
pre-tax. You may be able to take a tax deduction on a contribution, but the money grows on a tax deferred basis. So, you do have other products where you can get the tax deferral and some of the other things. But the reason why it's being sold is, the answer to any of these things is always it's all about the money. And the commissions that the insurance agents make can range anywhere from 50% to 100% plus of the first year premium. So if you
Yes,
have
I heard
somebody,
this. It's not only whole life insurance. I believe for a lot of insurance policies, it's like this, like healthcare insurance. What I heard, like even when I was in Hong Kong, is like 50, like 30, 40, 50% of your first year money that the client pays. So it's quite a lot of money.
Yeah, I mean, that's always the answer is follow the money. And
Mm-hmm.
that's why it's being aggressively sold. And so why young people are doing it is partially it's because, they're like, hey, this is what nobody wants you to know. This is, it's the way investments have always been sold that are not the best investments. It's like, hey, this is a secret.
Mm,
The insurance companies don't want you to know that this ha is going on. This is a way to outsmart the insurance companies. And that's another huge selling point that they use is like, hey, you can outsmart the insurance companies
mm,
by using this type of policy. And what they overlook is that insurance companies are huge, you know, entities, and a lot of them have been around for 100 years, some in the US for 150 years. And you even go back to Lloyd's of London, which is hundreds of years old.
mm,
And
mm,
so there's insurance companies around the world. Prudential, I know, is in Switzerland. I mean, these companies have
mm.
been around 100, 150, 200 years. So they have an idea of what they're doing. Insurance companies hire some of the smartest mathematicians. They're called actuaries who figure out the insurance rates. So, but it's always sold as like, hey, here's a secret. Here's something that they don't want you to know. Here's an easy way to make money.
Mm.
Did those sound familiar to you as selling
Yeah,
points?
it sounds so familiar. They know really play, like I mentioned, play the emotions so well. And Tony, you mentioned there are just a lot of misunderstandings regarding it. There are a lot of things those insurance companies or agency they don't or brokers, whatever we call it, like don't want those young people or the audience know. And definitely, you also mentioned some cons, let's say liquidity, right? Like we can explain it later on. What does liquidity mean? Liquidity and also, for example, among some other things, let's say. So I wanted to ask you that the next question I wanted to ask you is, what do people misunderstand about the whole life insurance when they sign up for it? Like you mentioned, liquidity, anything else that you wanted to tell us about?
Yeah, so first of all, is the liquidity, what that means is access to your cash is
Mm,
when you put money into a whole life insurance policy or other permanent life insurance policy, which includes universal life, index universal life, variable life,
mm.
there's lots of names in around the world. Different countries have different names. So it's basically any policy that builds a cash value. You have a surrender charge for the first up to 16 years of the policies, anywhere
So
from 10 to
basically, it
16
lock
years.
you in, right? It's such a long
It,
period.
exactly. And so in the first couple of years, it's 100% surrender charge, which means that if you try
Mm.
to take out your cash, you can't take out any of it because they're going to charge you 100% as a surrender charge. So in the year three, it might be 90%, which means you can only access 10% of your cash value.
Yeah,
So that's
that's
one
really
thing.
bad.
Yeah, that's hot. And the other thing that happens is because you have to buy a larger life insurance policy because of the cash value. So in the US, the death benefit has to be a certain percentage higher than the cash value and it has to meet some other things, which makes it so if you're paying $5,000 a year, you might need $1 million of life insurance to
Mm.
make it a life insurance policy. Otherwise, it becomes an investment contract and it loses some of the advantages that you get with a life insurance policy. Now, the huge thing that people don't think about is that you're paying for the cost of insurance. So if you're a 25-year-old, you're purchasing $1 million of life insurance, the cost of insurance, which is the risk protection, because the insurance company is selling you an insurance policy. And that's the thing, when you buy one of these policies, the first thing a life insurance policy says on the cover is this is a life insurance contract. It does not say anywhere that it's an investment contract. So you're paying
Mm.
for insurance. And because it's a whole life insurance policy, it's a very expensive type of life insurance. And for most people who are 25 years old, they don't have a need for life insurance. So those are the big two things that people don't
Yeah.
really think about.
And Tony, I believe, maybe you already mentioned it. I believe that if you see it as an investment, as most young people mistakenly believe, and the returns definitely now is not there, right? For example, I don't know the annual return of an insurance policy, in terms of evaluating the cash value. I don't know how much, but I believe it could be really, really minimal.
Yeah, it can take 15, 20 years before the cash value even
Hmm.
equals the sum of premiums paid into the policy. So, for example, if you're paying $1,000 a year for 20 years, that's $20,000 premiums. The
Mm.
cash value may not reach $20,000 until the 20th year. So,
Okay.
you have a long time frame before there's really money in there. Now, if you're overfunding it, which is how these policies are sold, and you're putting an extra cash into the policies, yeah, the cash value will build at a higher rate. And, that crossover may happen at an earlier age, but you're not really, like you said, getting a really good return on the cash value growth as compared to the premiums.
Yeah, yeah, definitely. And it is something quite important that, for example, as we know, compound interest, if you use compound interest like 10%, basically 7 years you can double your money. But if you really invest everything into a whole life insurance, just like I believe it's 1 or 2% for longer time, and especially the first few years, you have zero return or even have less if you want to take the money out, right? So over the long term, it can make just such a difference between you really invest in the stock or bond or balanced portfolio real investment portfolio versus investing in this whole life insurance. And Tony, one thing, just like a follow-up question that you mentioned, liquidity risk. I know some insurance companies or agencies, they tell you, oh, yes, you lock your money in, but when you need money, you can get a liquidity, you can get a cash, you can take a loan. So how do you respond to this? I know you briefly mentioned that. I just want to know specifically to this case. Their answer is yes, you can get liquidity by taking a loan, right? But how was your response?
Well, and that's the whole thing is that you're your own banker. Well, one
Mm.
is you don't have the cash available to borrow until the surrender charges are lower, which doesn't happen till at least the 10th year. So you can't even become your own banker until the 10th year, but you're not really your own banker because Charlene, if you borrowed
Ah,
money from yourself,
okay.
so let's say, you have a savings account with $10,000 and you take the $10,000 out from your checking account, is there any interest that's being paid? You're not paying interest to anybody, right? When you take your money out of your
Mm-mm.
savings account. Now, if you take money out of a life insurance policy, the insurance company is going to charge you interest on that loan. And that interest on the loan will be 7 to 8% typically. So
That high. Okay.
that high. So if you're your own banker, why
Okay. That's
you wouldn't
something I
charge
didn't
yourself money?
expect.
Yeah,
Okay.
so people don't expect that and they don't think about that uh, when they do it. So they're paying 7 to 8% on their money, which they're taking out on their policy. So they're not really being their own banker because you have an insurance policy and the insurance company is saying, hey,
It should be
you're
free.
taking money out of your policy. Now, when an insurance company figures
Yeah.
out the rates on insurance policy,
Mm,
they count on the money being kept in the policy. And on a whole life policy, it's actually a reserve account, not a separate account.
mm.
And what a reserve account means is that the insurance company is using that to offset the amount at risk to the insurance company. So when you take out some of that reserve account, the insurance company is saying, oh, well, that's going to interfere with our calculations on how much we charge for insurance. So we're going to have to
Mm.
charge you interest because we have to cover that difference. And the one thing we know about insurance companies is they're not your friend. They're not, they're in business to make money. And
Yeah.
you want your insurance company to be profitable so that they can pay the claim. If your insurance company is not profitable, they're going to go out of business and they're not going to be able to pay your claim. So the insurance company, in order to be profitable, has to say, well, we're going to have to charge you interest. Now, here's the other thing that people don't think about either. And when we're talking about comparing it to an investment, is the average expense charge on an exchange traded fund now is maybe a quarter of a percent. maybe 0.5%
Yeah.
on most exchange traded funds. Well, when you look at the cost of insurance and the overhead expenses that are assigned to a life insurance policy, they're going to be much higher percentage wise because you have to pay for the
Mm.
insurance.
Yeah, the fees are really, really higher, right? And then back to the liquidity question that I was asking Tony, if I understood correctly, on the first 10 years, basically you cannot borrow anything. And then after
Exactly.
10 years, you can, but the interest rate will be like 7 to 10%, which is insanely high.
Exactly. So,
Okay.
right now in the US, if you were to borrow money, let's say a home equity loan, well, for a 25-year-old, they're not going to have a
Mm-hmm.
home that they can borrow a home equity loan. So that might not be the best example,
Mm,
but the interest rate on something like that is going to be 6 to 7%. So, and it's not going to interfere. So the other thing is, so if you take the money out of the life insurance policy, the life insurance policy growth of the cash value is going to be less. So
mm,
you're
mm.
defeating that whole purpose of accumulating more money because you're taking some of the money out. So the insurance company is not growing the cash value at the same rate that's projected. So you have that
Mm,
impact as well. So it gets pretty complex. And it all comes back to financial literacy and
mm.
understanding how interest rates work, how loans work, how
Yeah,
insurance
for
policies
sure.
work.
Exactly. I mean, I didn't know the interest rate is 7 to 10%. If I knew it, I mean, for me, it's a no-go for sure. But I believe for a lot of people who are not that sensitive to these kind of, things like interest rate, inflation, what is the normal loan rate for a certain country, for example, in Switzerland or in the US, in the United States, I think they may not be, when they are not sensitive, they may not know, okay, it sounds like a good plan, right? So you never know. So Tony, so I wanted to actually just add a question here that you are an insurance expert or overall finance expert as well. So, and definitely whole life insurance has a role to play in the overall financial market. I mean, it existed for that I don't know what's the history of it, but it definitely existed for so long. So if you don't think the majority of the young people, millennials, should purchase whole life insurance, who are they really for? Who should purchase whole life insurance? What are they
Well,
for?
Well, it all gets back to understanding your needs and goals and being able
Mm-hmm.
to, match the right product. So, whole life insurance is good. So, the name says pretty much what it's really for is that it's to provide insurance for you for your whole life.
Mm-hmm.
So, the policies have a maximum age of somewhere between 95 to 121, which covers most people's lifespan. And what they do is because they go that long, the insurance company charges a level premium for that whole period. So it's a very high level premium. So who it's for is for somebody who has a permanent need for life insurance. So most people buy life insurance maybe to cover the mortgage on their home, which is a loan on your home,
Mm-hmm.
or they purchase it because they have a special needs child who is going to need money for the rest of their life, or they have some other financial obligation for the rest of their life. Now, most people don't have that need because they're accumulating money in their retirement accounts. So let's say you have $1 million whole life insurance policy, but you're also accumulating money in your retirement plan. So hopefully when you retire, you have $1 million plus in your retirement account.
Mm-hmm.
Well, then you don't need the $1 million life insurance policy because you've accumulated other assets that replace the need for life insurance. So that's the thing you have to take about look at is what is the bigger plan? And I think that's something that's oftentimes missed with these financial products is people are looking at them in isolation without understanding
Mm-hmm.
as we've talked about, well, what else am I doing? What's the right product to fit the hole that I have? And as I mentioned before, is to take a look at the expenses. So in the United States, term life insurance, which provides the death benefit only, is the most popular type of coverage and the type of coverage that most people need because it provides a
Mm-hmm.
death benefit only. The premium is maybe So the premium for a whole life insurance policy is 10 to 15 times higher than a term life insurance policy, because a term life insurance policy will go anywhere from 10 to 30 years. So,
Mm.
so you have to take a look at that, but it's really taking a look at your bigger plan and what you need to make that plan work.
Yeah, exactly. I totally agree with you, Tony. Since I've been working in the banking or specifically private banking industry, so actually from my perspective, or I have seen a lot of multimillionaires, billionaires, they have a huge, they have a big whole life insurance. I'm not just saying whole life insurance is only for the rich, but what I wanted to say here is that, for example, imagine if you only have, let's say, 10,000 USD or 20,000 or even slightly higher, 50, 100. I wouldn't suggest, I mean, since I'm also an investment coach, I wouldn't suggest put all your savings like 10K, 50K, 100K into a whole life insurance. Yet, if your wealth already reached that certain level, yes, whole life insurance provides you with tax benefits, provides you some benefits that we just talked about. But I wouldn't say I'm it is your first, go-to investment as a young person when you only have 10K, 20K, even 50, 100K.
Exactly. Yeah. And, I've worked with a lot of very high net worth people,
Mm,
and whole life has a certain, function as a diversification, as a different asset class. But when you take a look at somebody who has an ultra high net worth,
hmm
they're maybe spending less than 1% of their income on their whole life insurance.
hmm
So they're doing it for a whole different purpose. In the US, a lot of them do it to offset estate taxes, which is taxes upon their death. So, for the ultra high net worth people, they're doing it for a whole set of different reasons. And they're not doing it to
mm,
be their own bankers. They're using it
exactly.
for very different purposes.
Yeah, I totally agree with you. Since both of us, like you and me, Tony, we do not really agree if you only have 10K, 20K, 50K, and then you put all your money into whole life insurance for these young people or millennials. So, what is your will? I want to ask what alternatives could better serve young people's financial needs while maintaining flexibility at this point. So, what would you say? What do you suggest them invest instead?
Well, I'm not an investment advisor, so this is just my own personal
Mm-hmm.
perspective and how I've worked with my own money. Is if you want to save for longer term goals such as financial independence slash retirement, then use a retirement savings account, which is specifically set up for that purpose. But always look for the lowest cost expenses. That's where people can always save money. Is, you may not be able to maximize the return and get a higher return because, we can talk about stock market returns, and over the long term, markets return a certain amount and people don't beat the markets. Is you're lucky to get the market return. Is that where you can save money is by moving from a mutual fund that has a 2% expense charge to an exchange traded fund that is essentially the same. They're not exactly the same. Go out, do your own research, but with a quarter of a percentage expense charge. So if you're saving 1.5% per year on expense charges, that means your return is increased by
Mm-hmm.
1.5%. So to think about expenses first, but to think about your goals. So if you're saving money to buy a house in 5 years, you're not going to put it into a retirement savings account because you won't be able to access the money. So you want to put it into some kind of investment where you can get the money in 5 years that you're not going to worry about. And again, you might not want to be in aggressive stocks because for an aggressive stock portfolio, you want to give it time in case there's a market downturn. So you really want to think about your goals, your priorities, when you want to access the money, and then work from that. And then you want to think about how conservative you are, what level of risk you're willing to take on.
Yeah, I would say I love your answer, Tony. Since I'm an investment coach, so actually, just like back to this topic, actually, I've created a 5 steps, I would say, system to start investing as a beginner. And I would say it's quite in line with what you just mentioned as well. If you allow me, I will just quickly, share
Yes, please.
what I kind of I come up with as well. So currently, as an investment coach, I would always tell my students, start with your goals. So imagine you're a 55-year-old lady and want to have a really, relaxing retirement life soon, like in 5 to 10 years, versus if you're a 35-year-old man, you want to have your own apartment in 3 years, versus you are a 22-year-old woman, lady, you just want to retire early, don't want to get married. I mean, you cannot like invest in the same thing. A lot of people just ask you to, oh, invest in this, invest in Nvidia, invest in Tesla, invest in Google. So always start with your goals. So actually, I developed 8 essential steps to define your goal. And this is the first step. And secondly, we call it investigation. You really need to know. You don't need to know every detail, but you need to know the basic of the different asset classes and investment instruments like stocks, bonds, mutual funds, index funds, ETFs, real estate, REITs, cryptocurrency, all these kind of things. You need to get a basic understanding of it is the step 2. And step 3 is based on the step 1 and 2, based on your investment goals and the investment options in front of you, create your own specific personalized investment strategy. And then based on that strategy, step 3 and now step 4 is to execute. So you really click the buy button, right? You execute on it. A lot of people just talk, they don't do it. And then step number 5 is optimize. Like you mentioned, Tony, there are a lot of fees out there. There are tax issues. There are different fees, management fee, transaction fee, custody fee. How to optimize your portfolio, based on your own country. So these are my 5 step by step, I would say, principles that I follow or system I've built throughout, I would say, over the past 10 years. And that's exactly how I teach my students to learn how to get started in terms of investing. And it's quite in line with what you share as well. So,
And it's awesome. And, I think that you're spot on is that you have people, I recommend for people to have a system to follow and to think
exactly.
about these
System,
principles.
proven system. I mean, it can be so simple. Investing doesn't need to be, complicated. There's no secret. Just compound interest, having your own investment strategy and be consistent. And like the compound interest make the magic. Okay, Tony. I mean, enough topic about investment. Let's go back. I mean, before I let you go, Tony, I still have one more question regarding whole
All
life
right.
insurance or infinite banking or be your own banker, whatever we call. So since both of you, I mean, you don't agree or you see such a big issue out there, and but I mean, you're a finance expert, right? Insurance expert. You know how to identify these kind of issues or red flags. But a lot of young people, like especially when they do not have a finance or economics degree, so it's really hard for them, to identify, okay, here's a red flag, here you need to avoid these mistakes. So I wanted to ask you, are there any specific red flags people should look out for these young people when an insurance agency pitches a story to you? And how can young people educate themselves to avoid these kind of financial traps?
Well, in terms of educating themselves, is there's a lot of good personal finance resources out there. Make sure that it's a
Mhm.
credible resource from somebody who has some experience rather than somebody
Like
who just,
Charlene's YouTube channel and
I was
Charlene's
just,
free class.
I
You're
was
about to
just going to
say so,
say,
right?
exactly, from somebody like Charlene, who is a Chartered Financial Analyst, which is a very advanced degree for people who are not familiar with it.
Oh,
So there will be links, of course, to Charlene's website and course, but also, my podcast where I interview a whole variety of people across the financial services spectrum. Charlene interviews a whole variety of people across the investment spectrum on her podcast. So, all of our podcast guests, go out there, check out their books, check out their websites. Um, so look for people who have credentials, who have some experience, and who know what they're talking about. That's a red flag when somebody is just out there pitching a product and they don't have any real experience. Now, sometimes you have experienced journalists who become personal finance, content creators, and that's okay too because they have the experience. You can look and say, okay, well, if somebody wrote for Money Magazine for 20 years, they probably have a pretty good idea of how things work, and they can look at it from a different perspective. So, in terms of specific red flags, the red flag that you always want to look for is this too good to be true? You know, is it, are they pitching it as a secret? Anytime something is being pitched as a secret, that's
Mm,
not a good sign.
yeah,
That there's
so
no,
true, Tony.
yeah, and there's a saying that there's no magic in the markets, and there's no magic in financial services. There's no secret formula.
Mm,
There's no easy formula. So all these people out there who are selling, these ways to beat the market or these ways to get ahead, like, hey, if you be your own banker, this, most people don't know about this. We're going to tell you about that, uh, you know, take a look at somebody like Charlene in your system that teaches you how to ask questions. And that's the thing that I would urge people to do is to really think about being curious and asking questions. It's like if you go to the doctor, and I was going to say this is also a good example that gets back to earlier. If you walk
mm,
into the doctor's office, the first thing the doctor is going to say is what's going on with you. The doctor's not going to
mm.
say, well, hi, Charlene, let's talk about a knee replacement today without even asking you any questions.
Mm.
And that's exactly what's going on here is they're selling an all-in-one solution that has nothing to do with the problem that you're coming in because you're going to say, well, I've got a headache and, I've been coughing. A knee replacement is not the right solution to take care of your symptoms. And that's what's going on here is that it's being pitched as an all-in-one solution, to whatever problem ails you, this is the right solution. And that never works out well for anyone.
Tony, I really love it when you said when it's too good to be true. It is too good to be true. So what I keep telling my students is like investment is like this. There's no such investment brings you high return, no risk, and no liquidity risk as well. It's just like there's what joke that we made is like there's no such man or such guys in this world who, really rich and treat you like a princess and then available for you to you 24 hours. So when it's like too good to be true, it is too good to be true. I really love it, Tony. So I really learned a lot from you over, let's say, over the past, I think 45 minutes already. So now I'm, sending back the stage to you. I'm so
Yeah,
happy
well,
to
thank
be
you,
here
Charlene.
as a
And,
co-host.
well, and thanks for being a co-host today, and thanks for lending your perspective because you lend a great perspective from the investing side, which I think plays right into this. So appreciate it. So Charlene, where can people find out about you and your podcast
Mhm.
and your workshops?
Yeah, so currently I'm quite active on YouTube. So you can just basically put Charlene Cong, comma CFA, and you can find me. And also same name on Instagram and LinkedIn. So I also
Cool.
have my website, charlenecong.com, so you can find me there as well.
Awesome, awesome. And for everybody watching, listening, as always, there will be links to all of Charlene's outlets so you can get in touch with her and check out what she's up to. So, Charlene, thanks for joining us today on the Get Ready Money podcast.
Yeah, thank you so much, Tony. Thanks, everyone.
Yeah, and thank you everyone as always for tuning into this episode of the Get Ready Money podcast. If you learned something today to change the way you think about money, please be sure to subscribe and to tell a friend. Until next time, let's change the way we think about money.